Hi, this is James Shug with Westpac London's end of day report for Thursday the 21st of February. Well, it was a pretty bearish day on equity markets. There was a ongoing reaction to the Federal Reserve's minutes that were released yesterday to their latest meeting, which revealed that there was some consideration amongst some members of varying the amount of stimulus that the Fed might keep providing going forward. That sense that the policy could be adjusted has had a significant downward impact on markets, certainly in Australia yesterday and Europe and even the US today. There was a lot of data released today. I'll run through it quickly. We had flat inflation in January in the US, although the core rate was up 0.3%. The weekly unemployment insurance claims rose 20,000 to 362,000 in the latest week, reversing most of the previous week's fall. The Philadelphia Fed Factory Index dropped from minus 5.8 to minus 12.5 in February. That's in contrast to the New York Fed Factory Index earlier this week, which rose sharply. Existing home sales were up 0.4% in January, not fully reversing their fall in December. Looks like the supply of decent homes is a constraining factor there, with only 4 months worth of sales at the current pace of the current measure of inventories, which is the lowest it's been in since I think 2000 or mid 2000s. I think the most important data actually though was in Europe. It was the PMI, advanced PMI readings for February. They showed growth in Germany, both in the factory sector and the services sector, maybe a bit softer than in January, but the French services PMI in particular continued to slump. It's running just 2 or 3 points above the low it reached in the very deep recession of 2008-2009. So there's a real differential opening up between Germany and France. We've seen this for a few months now, and well, the true implications from this: firstly, the overall composite PMI fell from 48.6 to 47.3 in February. So if the average of the 2 months so far is the actual level for the quarter as a whole, that would imply about a 0.2% contraction in Euroland GDP growth in the current quarter, and that would make 6 consecutive quarters of decline, which would mean this recession is longer than the one we had in 2008-2009. Not as deep, but longer, and with less you can do about it because policy ammunition is pretty much used up, with interest rates already at 0.75% and fiscal policy constrained. So a longer recession than the last time, not much you can do about it, and risks being emphasised in relation to the French economy in that as the weak growth environment persists, it looks like France will underperform, making markets perhaps question the ability of the French government to keep servicing French government debt. The French haven't put in place the reforms to the extent that countries like Spain and Italy have done, and that could be a trigger for another iteration of the sovereign debt crisis, perhaps even more critical than the previous crises involving Spain and Italy, given the size of the French economy. So given all of that, we've got some big losses to report. The FTSE in London down 1.6% at the close, the French market down 2.3%, Germany off 1.9%, a similar loss in Spain, and a 3% loss on the Italian market. And the Dow at the moment is down 0.5% at 13,853. Aussie futures market's about flat, reflecting the fact that it already incorporated a lot of these losses. On the commodity market, oil was down down again 2.4% at $92.92 a barrel. Copper's off 1.5%, and we've got gold prices pretty much unchanged at $1,579 an ounce. The Aussie dollar, it's at 1.025 against the US dollar, a little bit weaker, but given previous falls, it's actually at its lowest since October last year. And of course, in Australia, we've got Glenn Stevens, the Reserve Bank Governor, testifying to Parliament. He does it a couple of times a year, and there might be some nuggets in what he's got to say, or depending on how smart the questions the pollies ask him are, or of course he might say something in his text, although that'll mostly be similar to the monetary policy statement that was released earlier this month. Okay, so that's it for today. I'll be back again tomorrow.